They told you the global economy was stable, they told you inflation was transitory, and they told you that billionaires piling into gold, shifting capital into China, and loading up on treasury inflation-protected securities were just diversifying. As if the wealth investors on Earth suddenly got sentimental about asset allocation. But what if that was never the truth? What if the world's most powerful players already know the exact pressure point, the exact weak joint that could push the entire global financial system into a 2025 to 2028 And what if Ray Dalio's recent moves aren't speculative bets at all, but strategically coded warnings? Behind the headlines, behind the sanitized economic commentary, and far behind the polite forecasts from central bank officials, a deep structural risk has been hiding for decades. A mechanism that caused the 2008 meltdown. A mechanism that nearly broke the system in 2020. A mechanism so fragile today, so stretched, so over-leveraged, that it could detonate the moment confidence slips. And the elites, they're already moving. Before we go deeper, tell me in the comments, where are you watching from? This is a global conversation now, and if you're new here, hit subscribe. This is where you get the unfiltered truth they'll never give you on television. No sponsors, no filters, because once you understand why Dalio is shifting into gold, China, and tips, you will understand the hidden mechanism that makes the next 3 years the most dangerous window since the end of the gold standard. Now let's pull back the curtain. To understand why Dalio's recent moves matter, we have to rewind not to 2020, not even to 2008, but all the way to the late 1940s, when the world rebuilt itself after World War II. The deal was simple. The United States would anchor the global monetary system. The dollar would be the center of international trade, and the dollar, in turn, would be backed by gold. Stability through metal. Money with weight. That system died in 1971 when the United States closed the gold window. Suddenly, the anchor was gone. The world panicked, and instead of collapsing outright, something stranger happened. Banks created a shadow version of the dollar, a parallel universe of offshore accounts, derivative structures, and unregulated credit creation that lived outside every official metric. Money was no longer what governments issued. Money became whatever banks promised. Sound familiar? This shadow system powered the petrodollar boom of the 1970s, the leverage mania of the 1980s, the derivatives explosion of the 1990s, and by the early 2000s, it morphed into something even more dangerous. Collateral the practice of taking a single piece of collateral, say, one treasury bond, and repledging it multiple times across multiple institutions. One bond. Dozens of loans, dozens of claims, dozens of hidden risks, and all of it off the books. This is the invisible structure that cracked in 2008. The global system didn't fail because a few homeowners defaulted. It failed because the collateral chain snapped. Suddenly every institution demanded real collateral, not synthetic exposure, not leveraged promises, and there wasn't enough for everyone. Sound familiar? In 2020, the exact same thing happened again. Liquidity froze. Repo markets seized. Foreign banks dumped treasuries like they were live explosives. And for a few hours, the global dollar system sat on the edge of a full-scale cardiac arrest. Today, the system is even more fragile, more leveraged, more dependent on the exact same pristine collateral that everyone is quietly losing faith in. US debt has exploded past historical precedent. Geopolitical trust has eroded. Countries that once absorbed treasuries unquestioningly China, Japan have begun to cut exposure or rotate away. And the global economy, older, slower, more indebted, more interconnected. The shadow system is now built on foundations thinner than ever, and the official system is blind to it. Sound familiar? This brings us to the twist almost no one talks about. The world's biggest risk today isn't inflation or recession or even geopolitical fragmentation. It is the fact that the entire global dollar system only works if the supply of trusted collaterals keeps expanding. But what happens when foreign governments stop buying? When the US issues too much? When banks stop trusting the quality? And when geopolitical rivals begin building alternatives? The answer is simple but terrifying. The shadow system begins cannibalizing itself. The same treasury is promised multiple times. The same collateral is duplicated across continents. The same assets appear on multiple balance sheets. Nobody knows who owns what. This is the mechanism Ray Dalio sees. This is why it's shifting into gold, because gold cannot be pledged 30 times. Tis, iswi, as. Moving into China, because China. U.S. internal credit system doesn't rely on U.S. collateral. This is why he's accumulating TISB, because they serve as insurance against treasury market volatility. Dalio isn't speculating. He's insulating. And he's doing it early, because beneath the surface of the global financial system lies what analysts whisper about, but rarely explain clearly: the collateral black hole. A hole created when the same asset is reused so many times that the entire system becomes a giant game of musical chairs. One that only works if no one ever stands up and demands to see the real collateral. But here's the part you're not ready for. The institutions at the center of this mechanism aren't the ones you think. The names involved, the offshore entities, the central bank arrangements. You won't believe the name at the center of it, and the receipt is wilder than you think.
The heart of the system lies in a simple but dangerous truth. Global finance doesn't run on cash, loans, or even central bank policy. It runs on collateral, and not just any collateral only. The cleanest, most trustworthy, most liquid assets qualify. For decades, that meant one thing: U.S. Treasuries. Treasuries became the passport of the global dollar universe. Banks used them to borrow. Corporations used them to hedge. Governments used them to anchor reserves. Shadow institutions used them to build multi-trillion-dollar webs of leverage. But here's the nightmare: the supply of real, pristine collateral hasn't kept up with the exponential demand created by the shadow system, so the system began to cheat. Quietly, efficiently, invisibly. The same bond gets reused. Again and again and again. Again. In London offshore markets, one treasury can legally pass through more than 20 rehypothecation loops before regulators ever notice. Imagine taking the deed to your house, handing it to 20 different lenders, and every lender pretending they were the only one who owned it. That's the global system, a multi-trillion-dollar ghost chain built on duplicated claims. Now add stress. A liquidity scare, a geopolitical shock, a sudden rush for cash, or a break in trust. Suddenly everyone wants the real collateral back. Not the digital copy, not the synthetic version, not the equivalent exposure. And that's when you get a cascade. In 2008, the system lost track of an estimated $2.1 trillion in collateral chains. In 2020, more than $700 billion in treasuries were dumped in a matter of days by foreign institutions. In 2023, U.S. interest costs surpassed $1 trillion per year, eating up more of the federal budget than defense spending. And in the shadows, the offshore dollar market grew to a size no one can fully measure, somewhere between $12 trillion and $20 trillion, depending on whose estimates you trust. That's the scale of the illusion. Now imagine that system trying to survive the next 3 years as global interest rates stay elevated, political polarization rises, and major economies begin shifting away from the dollar. Demand for pristine collateral skyrockets. Trust in that collateral wavers. Supply cannot keep up, and the invisible leverage built on top of it starts to buckle. This is why China is so important to Dalio's positioning. Not because China is safer, it isn't, but because China has an internal credit system that doesn't rely on the dollar-s collateral architecture. It is flawed, opaque, politically directed, but it's insulated from the U.S. Treasury dependency that defines Western finance. Gold plays the same role. Gold is final settlement. Gold cannot be printed. Gold cannot be duplicated 20 times on a balance sheet. Gold does not require another party to deliver on a promise. And TIPS Treasury inflation-protected securities offer protection from the one outcome elites fear most: a surge in inflation driven not by consumer demand, but by a collapse in trust. Because if the collateral chain breaks, the U.S. will have two choices: stabilize the system with a flood of liquidity, or watch global trade collapse. And historically, the choice is always the same. Which brings us to the institution sitting quietly at the center of this whole web: the Federal Reserve Bank of New York. Not Congress, not the Treasury Department, not the White House. It's the New York Fed, home of the global repo markets, home of the dollar liquidity swap lines, home of the institutional machinery that keeps the shadow system breathing. During the 2008 crisis, the New York Fed issued over $580 billion in emergency liquidity swaps to foreign central banks. In 2020, they did it again, this time reaching over $450 billion in a matter of days. These were not bailouts for American banks. They were bailouts for the worldwide shadow system running short on collateral, a global fire hose operated by a single institution that barely any citizen understands. The New York Fed's role in this system isn't sinister, it's structural. It became the emergency room for an architecture built on promises, stacked on promises, stacked on promises. And every time it intervenes, it makes the system more dependent on intervention, more fragile, more leveraged, more political. This is what Dalio is watching. This is what the elites are repositioning around. And this is the risk most people never hear explained. The moment when collateral scarcity becomes collateral panic. Picture it. A sudden sell-off in treasuries, a geopolitical shock, a wave of margin calls. Everybody demands the real collateral at once, and the system, for the first time in its history, does not have enough to deliver. A global margin call, a synchronized freeze in credit, a stop in trade financing, the kind of crisis that doesn't look like 2008, but something bigger, faster, and international. Could it happen in 2025? 2026? 2027? No one can time it, but the pressure is rising in a way that even the calmest billionaires can't ignore. The warning signs are all around us. Bond market volatility hitting highs not seen since 1987. Foreign central banks reducing treasury holdings. The U.S. facing annual refinancing needs north of $7 trillion, an unprecedented figure. And shadow leverage estimates so large, even the Bank for International Settlements admits it cannot fully map them. Money is becoming more digital. Trust is becoming more fragile, and the system is becoming more dependent on an anchor that is increasingly unstable. This is why Dalio says we are entering a new world order. Not because nations will vanish or currencies will disappear, but because the financial plumbing that held the world together for 50 years is aging, cracking, and becoming too complex to control. And here's the real warning. The next crisis won't be stopped by a single country, a single central bank, or a single intervention. The system is too intertwined, too global, too leveraged. When collateral panic hits, it hits everywhere. So what do we learn from all this? That denial is expensive. That trust is fragile. That a financial architecture built on borrowed time will always demand more. And that the institutions we rely on are often the ones hiding the fragility they're retrying to manage. Every generation faces a moment when the old system breaks and a new one struggles to replace it. We're approaching ours. Slowly, quietly, inevitably. And the question you should be asking right now is the one very few want to say out loud. Are we wiser now? Or just walking the same path in better suits? If you found this eye-opening, share it with someone who still thinks the financial system is unbreakable. And hit subscribe, because the more we understand together, the less blind we are when the next shock hits.